Hello everybody, welcome to another update on the Stock Screener. Today we're going to continue our talk about Reliq Health Technologies, and I also wanted to compare this to another company called Skylight Health Group. Just wanted to see what the differences are because this company has also caught my attention. So Reliq Health has actually gone up uh, in a year time, but Skylight seems to have gone up but fallen again, probably bottoming out now. But let's see how these companies compare. And we're going to do that via the financials. So I plotted all the earnings here of both companies from the uh, filings. And both are undervalued companies, but there are some differences. So let's take a look at the market cap. It's exactly the same. Both are 150 million CAD, but we see some changes here. Price to book is much higher here than here. So Skylight Health has more equity, much more equity. And that's because this business is different. They actually own the hospitals. Um, so that's where the equity comes from. And they also, yeah, keep buying hospitals. So the equity keeps increasing here. While Reliq Health owns nothing, they just own the software. So this is a pure SaaS play. Like a Microsoft, they just sell you the software and you just use it and then pay a fee. So these are completely different businesses, although they do sound the same. The debt, this company has much more debt than Reliq Health. This is 25 million debt. This only 1 million debt. So if you compare that to equity, it's actually a very high debt to equity. But then we come to the most important part, and that's the Ebitda margin. Reliq Health has a pure SaaS play and has much higher margins than Skylight Health. So Ebitda margin of this company was 10% last year. Will probably go up a bit next year, around 15%, 20%, but it will never be as high as a SaaS company, which will have 50% and more if revenues increase. So this can easily go to 60, 70% EBITDA margin. And we already have gross profit margins of 70%, here 60%. But you can see there's a large difference between gross profit margins and EBITDA margins here because they have a lot of costs. This company has less costs because it's a software company. Also, Reliq Health will not be diluting shareholders anymore because they are profitable and they do not need to buy things or get cash to grow. So no dilution here. They just build on their customer base. They sign new contracts and they sell the software. No dilution. Here, they will need to expand and buy more hospitals. They will need more cash. So there will be a dilution here. And yeah, to grow, they need to buy more hospitals. So that's the difference here and here. This company I call, they build the company by building customers. And this one, I call this, they buy the company. They buy hospitals. That's the difference. They grow by building and they grow by buying. That's the difference here. From price to sales perspective, this one is at 6 and this is at almost 4. So almost the same, but this one is cheaper from a price to sales perspective. But keep in mind, EBITDA margins are much lower. Here they are like 5 times higher. So this number is completely meaningless. This price to sales is meaningless because EBITDA margins are much higher. Actually, you can say that this company is more undervalued than this one based on the EBITDA margin and the price to sales combined. Okay, so I also looked up the competitor, Kano Health. It has a 10% EBITDA margin, so that compares to this 10%. So it's correct. EBITDA margins are completely different. Okay, so now let's take a look at the financials. So this is how it looks like. So currently, Reliq Health has revenue of 1 million per quarter. That's not a lot. That's 4 million per year. So this is very overvalued. But they say that they will grow. So today there are a lot of people who are very skeptical about this growth, but they say that revenue will go to 1.5 million per quarter, and then by the end of the year at 6 million per quarter. So this is what it looks like until the end of the year. Very high growth. And you can calculate here what the gross profit is, because it's 70% gross margin. So that will be this number. And then the net earnings will be a bit lower. So that's how I calculated this number here. 70% of revenue, and then net earnings are just divided by 2. So that will give us an estimate of the numbers in December. And they say that they will keep growing their patients base. So revenue, the blue line, will keep on rising and rising like this. So this is like an exponential curve, probably going much higher, like this. I don't know where this will plateau, but this is the curve that the company is guiding for. And of course, gross profit will stay at 70%. And then we have the net earnings at this here. EBITDA margins will probably go 50, 60, 70% in the future. So I think the net earnings could be even higher. Then from the net earnings, I calculate the equity. So the equity will grow like this and will probably reach 50 million or more in 2 years from now, in 2024. So in 2024, we will probably be almost at book value of 50 million. So can quickly go to, if you look at this, can quickly go to 100 million, 200 million, and then we will be at the market cap already. So that's the play here, high growth. Revenue will be at 30 million per quarter or 120 million per year. Add a 10 multiple to that, and we have $1 billion company. then the net earnings will probably be somewhere here. Could be even 20 million per quarter to 15 million per quarter. Let's say 15 million. Then you have 60 million earnings. So 60 million added 10 on that, PE of 10, that's 600 million at least. So this thing here can fivefold in 2 years. And even more if you do a price to sales of 10, then it can be a $1 billion company in 2 years. But of course, all depends on if this will pan out or not. So that's the risk here. Could easily also be that revenue stays here flat and doesn't grow, or it can be even higher. We do not know this. Only the future can tell this. Now let's take a look at Skylight Health. Here you can see that revenue is pretty constant, and from here on it starts rising. Gross profit rises as well, but very important, net earnings are still negative. They're still negative. While Reliq Health says that it will be positive in the third quarter and going forward. So that's a very big difference. This company is not earning money yet. This company is earning money. So why is this? It's all because of costs. You can increase revenue as much as you want, but if you have costs that increase as well, then you will not make any money. And that's why I'm going to show you in the balance sheet what's happening. So this is the balance sheet from March, and this is from June. So we can see that revenues went from 5 million to 10 million. So that's a double in revenue. But look at the costs. Cost of sales 1.6 million and doubled as well to 3.7 million. So as revenue increases, also the costs increase. This is not the case with Reliq Health. As the revenue increases, the costs won't increase because it's just a SaaS company. So they can just leverage on their software. But this company has a lot of costs because it's a hospital. And okay, so gross profit also goes up. But then here the operating expenses, 2 million salaries went to 4 million. That's a double. Office and administration, 500,000 went to 1.7 million. That's a triple. Marketing, yeah, marketing is the same. Professional fees, also doubling. Rent, 28,000 went to 100,000. That's fourfold. So you can see here the depreciation also doubled. So all the costs are doubling when revenue doubles. And this leads to a loss of 2 million. And here we have an even larger loss of 3.5 million. So this company still needs to bring us positive earnings. So we will need to see if they can achieve that or not. Also, a difference here is, look at the yellow line. This is the equity. Why has the equity gone from 1 million to 25 and then 40 million? It's because they have been diluting shareholders and they have been buying up hospitals. So that's why the equity is going up like this. And we don't see this here. There's no dilution here. There's only increase due to earnings. This equity is increasing due to dilution. And that's why the market cap is so high, because they have been increasing the equity via the markets. This is the balance sheet of Reliq Health. So they also have costs, but these costs will not go up, okay? So promotion, I don't think they will increase promotion that much. Amortization, maybe. Management and consulting fees probably stay the same. Offices, they don't need that many offices to push the software. Professional fees or maybe go up because they need more people. Okay, so research and development will probably need to stay here the same to build out their software, and then some salaries and wages. But it's not like this will go up so much. These are fixed costs mostly, while these costs depend on how many hospitals they have and will also go up as revenue goes up. So this is a big difference. Here you will see increasing margins as revenues go up. Here the margins will stay the same. They will stay the same at 15%. This will go higher and higher as more patients get onboarded. So yeah, I think Reliq Health is the winner here due to a much better business model than Skylight Health, but both are very good companies. This one has risk of execution, so execution risk, because this is just guidance. They still need to make sure that they hit this guidance. So that's the risk for Reliq Health. And here we have the risk of costs and low margins. So that's the risk here, and dilution, of course. As they want to grow bigger and bigger, they will need to dilute more. So this is our comparison. Hope you liked it, and I'll see you in the next video. Bye.